Well, it's just gone midday, which means it is once again time for the call. 10 stocks, 1 hour, and 2 experts. We're going to give you the lowdown on exactly what you should do, buy, sell, or hold with the stocks that you, our viewers, have sent in. Well, today I'm joined in studio by Jason McIntosh from Motion Trader. Jason, great to have you on the show.
Andrew, great to be back in the studio.
First time on the call.
First time, looking forward to it. Seen there's lots of good stuff spoken about in recent weeks, and yeah, hope I can add a bit to it. It's a lot of people say, understand the company you invest in. I've got a bit of a tweak on that. It's more understand the process that you use to invest with.
Okay.
So for me, it's all about looking at the price action, looking for the trends, and when you identify a trend, it's using risk management to get on that trend so that you can potentially get the upside whilst having a get out point if it's not working out.
Okay, excellent. Well, we'll get a bit more colour on that as we proceed through the show. And joining us via Skype, we've got Carl Capolinga, long-term friend of the show. Mate, always good to see you. How are things?
Yeah, good afternoon, Andrew. Good afternoon, Jason. Things are very good over here in the West. Beautiful sunny day outside. Things are pretty good on the market as well, so I can't complain at all.
Everything is coming up trumps. That's brilliant. And we've got a new president as well. So what a great day to be alive. Let's start, if we can, gents, before we get to our 10 viewer nominated stocks. Let's look at our stock of the day. We thought we had to go with Tinybeans. Now, this is probably a bit under the radar for a lot of people. They provide a social media app, but one built around privacy for sort of sharing kids' photos, essentially. It had a pretty good result out today, record revenue and hitting cash flow positivity, which is always a nice thing to see when it comes to a small cap growth stock. Carl, is it one that you follow?
No, it's not, Andrew, actually. And I keep saying this when I come on the show. This is why I love coming on the show, because I find out about stocks that I maybe didn't know about. I get to do a little bit of research on them. And quite often, like with Tinybeans, I like them. And I think this is a very, very interesting stock. Now, Jason mentioned in his introduction, I guess, his philosophy or methodology. So it sounds like he's a bit of a technical analyst. So ditto over here. Said he's a trend follower. Double ditto over here. For me, if you're a trend follower, look, you're never going to get the bottom, you're never going to get the top, but that's not your objective. Your objective is to get the big bit in the middle. And obviously, as Jason says, you want to have some rules around how you do that. But I do like to look at the fundamentals as well. And for me, it's about finding the right stock at the right price. And the technicals help me determine when the right time is. So let's go through that checklist. I think this is the right stock. I think it looks very good. It's got a great product. So these guys do a photo journal / social media app for parents with, look, I was going to say young children, but maybe I've missed the boat. My kids are a bit older, but certainly I could imagine if this was around when I had very, very small children, I'd like to use it. So you can share your photos with a group, with a family, in a very, very safe way of doing it. But it's all about not just collation, but curation now as well. So you get to make it look very pretty as well. And I know a lot of parents out there like to do that. And it's it's a photo journal essentially of their lives. So it's subscription based. It's a freemium product. You download it from the App Store. It's actually been Apple's app of the day twice in 2020. It's got 4.8 million subscribers. That was up 800,000 in the last quarter, 300,000 the quarter before that. So It's not linear growth. It's got sort of exponential growth here. It seems to be just catching on. It's just gone cash flow positive. So it's first quarter of cash flow positive. It's been operationally cash flow positive for the last couple of quarters. And that's just sort of accountant speak for if you back out research, development, and one-off costs, then it's making money. But I would suggest a company like this, that's silly to back those things out. They are part and parcel. But look, it's on the right track. So I think it's the right company. It's got a great product. It's growing subscribers very quickly. It's well received by the market. Over 92% resubscribes. And the price isn't bad either. So that's the second checkbox. It's probably not going to earn any money this year. It'll probably break even this year on the current run rate. But then in FY22, I've got it earning anywhere between 2 is a very conservative estimate, up to about 7 cents per share. And if we just take the midpoint of that, that means you've got an FY22 P of 40, which sounds high, but for a growth stock of this magnitude, I don't think it's high, because you basically halve that in FY 2023. And that kind of gets me to the point here, which is this is a longer term play. This is not a buy now and expect this to double over the next few weeks. It's a buy now and expect it to double, triple over the next few years, because it's kind of hit that critical mass now where it's got enough subscribers that we go cash flow positive and the profits start to roll in. So check on the right stock, check on the right price. Now it's about timing, and I don't think we're there on the timing. So we've got 2 out of 3 boxes right. The trend isn't terrible on the chart. I do have a long-term uptrend, but it's a fairly flat one. So I'd like to see a bit more excitement come into the chart here. I wouldn't buy it now because I want to see a little bit more momentum come in. I think 160 is the key level. It kind of doesn't make sense to say we'll buy it at a higher price. We want to get things cheap. But when it comes to technical analysis, it's about buying things when there's momentum, when other people are starting to see what you're seeing in the stock. So through 160, I'm definitely a buyer on this one. Right now, it's just a wait and see.
Well, you might not have to wait too long, Carl, because shares are up about 15% almost today. Jason, does it tick any boxes for you?
Yeah, look, you've got to love a good subscription model. And look, they're great businesses because subscribers tend to come back, they renew each year. Carl's saying they've got a high retention rate, which is just fantastic. It's look, it's not a stock that I know a lot about. Not a little bit. I get a daily email from them. I basically get an update on what my sister's kids are doing because they're subscribed and they've signed me up. So so yeah, I understand the picture diary of it all. It's actually pretty good for seeing what your family and friends are up to. And but look, from the chart perspective, that's where I'm most interested. I have a look at that, and like it had a really big run up in 2019.
Yes.
And look, the market looks like the people who are watching it seem to get probably a bit carried away with the story and the potential. And then COVID's come along and it's absolutely crashed. So it's really got that boom bust profile. What we've seen over the last
over $3.
Look, very much. So look, what we've seen over the last probably 9 months, it started to, it's formed a base. It started to ratchet higher again, and you can see the momentum's coming in on the up moves and on the down moves or the consolidations. They're fairly flat, so that's a pretty good sign for me. Look, like Carl, I'd like to buy this into strength. I wouldn't like to just come in and take it now. Look, breaking above the December high around $1.70. That's probably around the mark for me, so pretty close to Carl's mark. And look, over the next maybe 1 to 2 years, I think it's very much got the potential and the profile that could take it back up to those previous highs we saw in 2019. So risk reward wise, I think it's pretty compelling.
Yeah, it's an interesting business. I think it's also a good case study too in the market often getting carried away with a good story. We see it all the time. A business that has very attractive potential, getting some early runs on the board, the market just goes, parabolic, and things just run too far. There's no way that the company can deliver on such ridiculous expectations in such a short time frame, and then everyone piles out the door again. But as Carl was sort of saying, there's actually a pretty decent business here that looks like, and for those that I guess and he's made the point of sort of looking at this from a longer term perspective, there could be something in that. So viewers, I hope that has given you some food for thought there with Tinybeans. We'd like to bring you some new ideas every now and again. But let's get into the 10 stocks that have been suggested by you. Jason, I'll start with you this time here. Vihar has written in about Goodman Group. This is a property business. It's one that's actually done very, very well over time. In fact, going back to 2011, their earnings have compounded at about 17% per year. Very steady, reliable, increasing dividends. So it seems to tick a lot of boxes, although it is on a PE of 25 and a yield of 1.7%. Is this a space, Jason, that you typically invest in?
Yeah. Look, I'll look at everything from the smallest companies to the largest companies, and I'm looking for momentum, and momentum is which draws your attention to ideas. And Goodman's it's a big, solid, well-managed company. It's an industrial property company, so they've got operations around the world: Australia, Asia, Europe, North America, Brazil. It's great management team. You look at the average tenure of the board, and it's something like 14 years. So that's something which is always good to look for in a company. You've got good, stable management. They've got a model that works, and they keep replicating, and they keep getting good results. Yep. So ticking a lot of boxes there. 1.7% dividend, not as flash, but look, they do retain a lot of their their earnings to funnel back into growth. So, and it is a growth stock, and that's why you're paying that higher PE. Look, it's another, just slightly on the negative side, the CEO and the deputy CEO just sold down a few of their shares. Relatively small to compared to their overall holding, but nonetheless, maybe it's just like trimming their positions a little bit. I'll look at the share price now, and well, look, you look at over the last 10 years, and it's been a gangbusters rally. It's gone up a huge amount, and
even in the last 5,
it has. Look, a mistake I think a lot of people will often make is they'll look at it over the last 5 or 10 years and say, oh, look, it's gone so far. It's the best gains are gone. It's too late, and they don't go any further. But what Tal shows is these big trends can last a long time. It's a good company, good management. It can keep performing. Would I buy it right now? No, I wouldn't, because it's pulling back. It was recently at $20, now down at 17.5. A lot of people talk about buying the dip, but look, where do you buy? What part of the dip do you buy? Do you wait for it to be back 10%, 20%, 30%? No one knows. No one knows where it's going to base. It could well base around here and head back up, but I'd rather buy into the momentum on the upside than punt that it's going to base around here. Market history is full of the unexpected and the unimaginable, and you never know. So I'd rather not buy the weakness. I'd wait for the strength.
So like the business, don't like the price action. I think you make an excellent point though on the dangers of anchoring. We all do it, don't we? Look back and go, oh, it's too late. I could have, I should have. Now it's gone too high. It's just, guilty as charged in many respects there personally. Carl, what do you reckon about Goodman Group? Jason makes some good points there. Do you agree with him though in terms of the price momentum?
Yes or no? Yes and no. Look, I think if Tinybeans is at the exciting end of the spectrum, Goodman is at the exciting end of the boring spectrum, if that makes any sense. And I guess as an investor, you set, it's like picking a footy team, right? And you have different players for different positions, and you might have a Tinybeans in there, which is all upside and it's a small position, and you're taking a long-term view, and then you might have a stalwart like Goodman in there, which, as I said, is the exciting end of the boring spectrum. So it's a boring stock. It's got great history, as you said, in terms of its compound annual growth rate, great management, and it's in an exciting space. So these guys do all the warehousing and infrastructure developments, the structures that Amazon then go put their warehouses in distribution centres. Main revenues come from Asia. It's a massive growth through there, and then Australia, New Zealand, and very small exposure to the US, which is probably a good thing right now given the COVID situation. So, it's certainly the right company. It's just about getting the right price and then the right time. And I think in terms of the price action, it has pulled back. And then buying these pullbacks, as Jason says, there's a higher risk involved. So you've got to decide what type of investor you are. Are you happy to take on higher risk to get higher return? Because if you can pick that pullback well, obviously by the time it starts to get back into the trend that Jason's talked about, you're already up quite a lot. You can adjust your stop losses, et cetera, et cetera. So it's higher risk, but it's also higher return. I think it's pulled back to a really interesting level here. It's at a long-term level of support for me. And then it's like Jason said, well, when do you know when to buy? And I think you've got to look to the market, the price action again. And if you see some of that buying coming in at those known levels of support, I think you can back it and go with it if you've got the quality stock. And I think this is a quality stock. So I'm happy to buy it right now based upon where it's pulled back to and the fact that it is in a very, very long-term uptrend. So I think it deserves a spot in your portfolio because it is, yes, it's a higher PE, but due to where they're operating, the growth they're getting, and just they're so well run, I think they deserve that higher PE compared to their peers. This is, I think, I'm not going to say I think this is still my top pick in the property sector.
Okay, nice one. Hey, let's move right along. Carla, I'm going to stick with you. Let's talk about high PEs here. Here's one for you. PE of 60 for Cochlear. Now, this is a real stalwart of the ASX. We've had Jock write in asking about it. Now, we all know that there's always, the devil is in the detail here. Earnings have taken a real knock due to that patent infringement. Is it right to look past that at more underlying earnings capacity, or is this just something to avoid?
Yeah, look, I think you've got to look past that patent infringement and the settlement that they've had to make there, or the pending settlement. You've got to look past their COVID issues as well. And we talked about valuations before. So we talked about a PE of roughly 20 for Goodman Group, and I said it deserves that higher PE. Now you're looking at double, depending on what they're going to earn. It could be triple that for Cochlear, and you have to look through so many things. You're not looking through anything for Goodman Group. They're going to grow. Cochlear, their earnings are probably going to shrink, at least in this FY, and maybe into the first half of the next, before they start to get that great growth that justified their high PEs prior to this crisis. So if you can look through those things, and that's not me, I'm not a person who wants to sit there and wait for all of that execution risk and hold this stock in the meantime. So look, it's a no from me. It's not a terrible stock. It's a fantastically run stock. It's a fantastic product. It's a premium product. It is the go-to product in this space. We're talking about obviously audio implants and wearables. In terms of people who prescribe these things, it is where the market is going. So great product, great company, great history. It's just not the time to get into this right now. And the chart is reflecting that as well. So we've had a breakdown of key support. I can't see where the next support level is going to be. We're not reacting in a positive way at around that level anyway. So had a bit of a bounce, but I still think the actual long-term trend has actually switched to down for the time being. So whilst that long-term trend is down, it's not for me.
Yep. Okay. Fair enough. Jason, what do you think?
Yeah, great company. It's like I remember back in the late 90s and the mid 2010s where some analysts would come out and say, look, too high a PE, expensive growth stock, leave it alone. And you look what it's done now. It's like Goodman. It's got these big trends which have endured over many years. And but look, it's been a rotten year for them. Profitability is down about 40 or 50%. COVID's behind a lot of it. A lot of the elective surgeries where you put these implants in have had to be put off. Look, they're saying, the company's saying they're starting to see growth picking up again in the US, which is probably surprising given they're still COVID hotspot, and also Germany and Korea. But then they say they're also like seeing growth still decline in the UK, Spain and Italy. So it's a mixed bag, it's uncertain. It's probably, like on the fundamental side, it's a tricky time to move forward with the stock. Look at the price action, it's now trading. Look, it tried to have a bit of a run up last year, but that momentum wasn't able to be sustained. It's since pulled back. It's now trading below the 100-day moving average. So for now, I'd say it's probably best to just to stand aside. It doesn't pay much in the way of a dividend at the moment, so you're not being paid to wait. So I really don't see, from a risk-reward perspective, I don't see the hurry to get in. So keep an eye on it, watch it, and reassess later on. Okay,
there you go, Jock. Hopefully some added perspective for you there. Let's talk about Zelira Therapeutics. ZLD is the code. I wasn't aware of this one, Jason. Ben has sent it in. This is sort of in that medical marijuana space, more of a pharmaceutical bent here, developing some cannabinoid products. From what I understand, they've actually launched 2 formulations, which is in market and generating revenue. Although, of course, early stage company, and the company does seem to be bleeding cash at this stage. Is it one that is a kind of business that floats your boat?
Look, it's one of these interesting companies which, in the depths of the ASX, which most people will never come across. Its market cap's 115 million. It's outside the All Ordinaries. It's it's called, the product they work with is cannabinoid, so that's a compound of cannabis. And so they've got some clinical trials in operation. Their main product at the moment seems to be this treatment for insomnia, chronic insomnia. Now the company says there's some, I think it's 10% of Australians suffer from chronic insomnia, of which 1 in 5 don't respond to the current treatments. And so the Therapeutic Goods Administration have given approval for this product to be rolled out on a prescription basis. So look, you just never know. If they have some success with that and they're able to roll it out further, they've got global reach with these things. These stocks can perform really well. It's about managing the risk of getting into it. So it's 20% of the company is owned by insiders, which is always a good thing. You want people with skin in the game running your company, because everyone's on the same vested interest page. And when I look at the chart, look, it's actually got quite an interesting chart profile. It does have the ingredients for an uptrend. The moving averages are rising. The share price has been rising. What's really interesting to look at is the volume profile. And so when I look at the volume of this stock, when the shares have a run up, they've run up on high volume, and then when they go, they consolidate and they pull back, the volume's dried up. So it really suggests that there's accumulation of this stock, and the people who are accumulating it, they push it higher, they step back, let the market breathe, and push it higher again. So fundamentally, I don't know where it goes. It's not the sort of stock I'd typically put forward to my members, but look, I think the share price is doing the right thing. There's a high potential story there. So for people who are interested in this sort of field, it's one of those plays where you could look at, you can manage the risk on it, and there is substantial upside potential.
Okay.
Potential being the operative word.
But it's not a buy for you though.
Look, no,
Okay.
I wouldn't buy it.
All right. Carl, what do you think here? It's one of those businesses that if they do get some traction, the sky's kind of a limit, but there's also probably some lessons from history here as well. We know that statistically they don't usually work out.
Well, they're throwing everything they can at it, I guess, Andrew. So they expect to have 15 products in the market by the end of this calendar year. They've got plenty of trials and studies going on at the moment. As Jason said, there's one for insomnia. There's also one for autism, which is actually they've had a couple of licensing sales in the US for, and that's generating their only revenue at this point in time. With that many products coming on stream, maybe you could think, well, one of them's got a hit, but then how much does it hit? It's so early stages for this one. Is it the right company? Look, if I really squint, I can say the management seems to be making the right noises. They seem to have the right experience when you look at the letters after their name, and I think they're going about it the right way. It's a very scientific approach. Is it the right price? No, I don't think so. I don't think there's in terms of the value. If you extrapolate our earnings, you can't even see them. You can't see these earnings yet. So it's hard to extrapolate it out and then say, well, this has got a PE ratio of this in FY23. I can't do that yet. The chart actually looks half decent, but I'm not sure if that's more to do with the fact that the sector's running right now. It's a very hot sector. So as I say, rising tide lifts all ships. Jason said something very interesting. He mentioned the volume. I'd certainly like to look at volume as well. If you look back August, September, and just as an exercise, viewers need to go do this. Go and look at the volume in August, September, and the price was very, very flat while this was happening, and volumes were elevated for about a couple of months. So that is basically insiders or people who know the good news that might be coming. They're getting in and they're clearing out the dead wood that have been stuck in it forever. And then the price starts to go after that huge volume. What I noticed though, and its peak back in December, where it really spiked up to 14. It was 6 when the insiders got in. It hit 14, and then volume spiked up again. That tells me that some of those insiders got out. So the last little push up hasn't got anywhere near that spike in December. So that would tell me that whilst the long-term trend is good, I think the short-term trend is starting to diminish. So I can't make a case for it on the right stock. I can't make a case for it on the right price. It's hard to make a case for it at the right time either. We talked earlier. Just want to make final point, because I know you always hurry me up, Andrew, and I respect that.
It's not just you, mate. It's everyone. We've got lots of experts who know a lot of stuff.
I do talk too long. I'll make one final point about this. I mentioned about finding spots in your footy team, about picking stocks within your portfolio. If I had to choose between this one and Tinybeans, and potentially they've both got great upside and great growth, etc., in the right space, I would pick Tinybeans every day of the week, because I can see a way that they're going to make money.
Yeah. Excellent point. Hey, Carl, I'm going to stick with you. I'm going to talk about another company that is probably under the radar for most. Esports Mogul, ESH is the code. Aaron's written in about this. This is one that runs esports tournaments and has a matchmaking system for that. Very illiquid, very small company, only a very tiny amount of cash flows, or operating customer receipts, I should say, at this point in time. So it does seem pretty speculative, but it is a big market, and it is one that the industry is growing very strongly. Is that enough to get you over the line?
Yeah, it's one of those total addressable market things, isn't it? So The total addressable market is about $50 kajillion. And these guys have a product within that space, and if they get 0.000% of $50 kajillion, they're going to go to $1 million in terms of their share price. Of course, a few exaggerations in there. Look, the great thing about being on this show, and if we're behind time, I can do things pretty quickly on this one. So this is it's not the right company. I can't see a pathway to them making enough money for it to have any value, and the chart's not that fantastic. So over to Jason.
Yeah, Carl's I think on the money there too. There is a difference between a very sexy narrative and a business that you can have a high degree of confidence will be generating cash flows in the not too distant future. And it's just hard, isn't it? Does that keep you away from something like this, Jason, or are you one that's more optimistic on potential?
Look, I don't really understand the esports business that much. It's not an area I'm particularly across. Look, market cap of 51 million. It's been around since 2011, so they've been at it for a bit. The company says there's some 500 million players of esport across the world, and the market's worth $176 billion. So, it's that big alluring pie. Like, can we get a little bit of it? Like, who knows? I don't know. It's one of the interesting things they've done. Just a recent board edition. A woman by the name of Kate Vale. So she was previously MD of Spotify, and she started off as Google's running Google in Australia.
That is a really high-profile hire.
So it's I think that brings some credibility to a company which we probably don't know a great deal about. They've just done an $8 million capital raising, and they say that'll give them scope to run the company for the next 2 years. They've got 2 years of cash flow, so they've got a 2-year runway to get this going. If they start to get something happening, probably they raise more cash and things go on there. From a fundamental perspective, look, I couldn't say to get involved. Look, the chart doesn't look so bad to me. I thought the chart looked, somewhat, it doesn't look fantastic by any means. Not a stock I'd go for myself. But if you're a punter and you wanted a pure speculation, it's like the pharmaceutical stock. The upsurges, the up moves have been accompanied by strong volume, and the down moves and consolidation have been on low volume. So there does seem to be interest in accumulating the stock. Where it goes, don't know. I wouldn't buy it. But when I ask myself, could I make a multiple of my risk in this stock? Look, I think the answer is yes. Although substantial risk, speculative.
Yeah, and we saw from that chart before too, which was a very what's the word? Stepped might be the best way to describe it. It is very, very, very illiquid. So just bear that in mind. We've had 87 trades go through the market today. So that was from Aaron. Thanks for sending that through, Aaron. I hope it has helped you. Sandy's written in and asked about WhiteHawk, WHCO. Jason, so these guys in the cybersecurity space. So it looks to me as though you can get on there and hire a white hat hacker, sort of probe and test your systems, and then after you've done that, perhaps find a solution. It is another one of these areas where we know the industry is growing really rapidly. We know that this is going to be an increasingly important part of the economy, but it's also very competitive. WhiteHawk is doing okay, it seems. Their revenues doubled pretty much last year, albeit off a low base, but it is still loss-making. Given all of that, is there anything that would tip you into it?
Yeah, look, it's another one of those stocks from outside the All Ordinaries. $66 million market cap, so it's probably not on the radar for most people. Look, they've got contracts with US government agencies. They work with large corporations right through to mid and small cap businesses. It's again, it's one of those big markets, and there's probably like cybersecurity and hacking is becoming a bigger and bigger industry. They've got a foothold in there. They're based both in Perth and Virginia in America. And their CEO is a woman by the name of Terry Roberts, and she's interesting. She used to be the deputy director of US Naval Intelligence before coming across to the private sector in I think around 2010. So presumably she's got she's well connected within that intelligence space. Maybe that's a plus for the company. Their invoicing for quarter 3 was about $1 million, which was up from about $500,000 in Q2. So it's moving,
strong growth.
It's got growth. It's moving in the right direction. Cash burn's relatively low. So look, when I look at the share price, it ticks all the key momentum triggers. It's we've got a rising trend. The moving averages are up. There's momentum in the near term. It's look, I'd as a speculative buy. I think of the speculative ones I've seen so far. This is the pick of them.
Okay.
This would be the one. If I was going to take a speculative play today, this would probably be my one.
Hey Carl, what do you reckon? The chart looks pretty good.
Yeah, no, the chart looks fantastic. No, we like it. We've had it as a buy for a while now. And it's not just, I said, right stock, right price, right time. Look, it's a little bit more speculative, maybe a little bit more speculative even than the Tinybeans that we talked about before, because whilst that's a sort of a subscription ad revenue model, the cash kind of just keeps coming in. These guys need to a large extent, go out and hunt for contracts, need to apply, be vetted, and then secure those contracts. So their earnings are a bit lumpy, and that's why it's hard to say whether they're cash flow positive or negative at any stage. I think they're going to go cash flow positive based upon their current run rate and their outstanding receipts in this quarter. So that should be a bit of a milestone for them. They do have a subscription-based business as well, so software as a service, where it's sort of monitoring your cybersecurity abilities and threats, and that is starting to grow as well. So as that starts to increase, that lumpiness in the cash flows will dissipate, hopefully, and then we start to get some reasonable earnings, which we can then make a valuation for. But we like to have an exposure in the space. It's about picking the right members for your team. I think this is a good one in the cybersecurity space. They also have an exchange, a bit like an app store for cybersecurity products. But the good news is it's not the App Store. So if I go to the App Store right now and I go cybersecurity, I'm going to get a lot of rubbish, let's face it. And probably half of them are hackers trying to get into my system. Yeah. So these guys have been vetted by US Department of Homeland Security, by the US military. They've got contracts with both of those institutions. So it's going to the App Store where these guys have vetted the products that you're purchasing. So for your small to medium enterprises, it is a bit of a no-brainer. Yes, there's competition in the space, but it's a very unique, a very interesting concept. So it's definitely one that we like. We hold it, and we continue to hold it here. And it's nice to see the share price going up as well.
Well, there you go. That is our first double buy for the day. Let's have a quick summary of the stocks we've gone through. We started off with Tinybeans as our stock of the day. Some really positive things to say from both of our experts, but they're wanting to see a bit more price momentum come in before they would buy it. So $1.60 for Carl. Jason was at $1.70, so pretty much not too far away from each other. We then went to Goodman Group. Now, this is a property company that's had an excellent history, very, very strong growth, very long-standing board members. It was no for Jason, but it was a yes for Carl. We then went to Cochlear. Again, this is another business that's just got a remarkable long-term history, although it hasn't had a great year given what's happening with COVID. The guys kind of feel as though there's probably a little ways off before there's any great catalyst for things to take off again. So on that basis, the comment was really, there's no rush, so no one's buying it there, according to Jason and Carl. Then we talked to Zelira Therapeutics, doing medical marijuana type products, introducing a whole range of products. Very interesting space, a lot of interesting science being done here, but at the same time, it is very early stage. There's a lot of unknowns, and for that reason, these gents were in no particular hurry to get in. We then spoke about Esports Mogul. Sort of a lot of comments similar here as well. Definitely an interesting space, definitely a lot of potential, but very, very early stage, very, very illiquid. The fundamentals aren't really there at this stage, so perhaps for a watch list, but not one to buy at this point. Then we got to WhiteHawk Security, and as you've just heard, this is a business that's got some really interesting characteristics, and there's a bit of price momentum in there as well. So that was a buy from both of these guys. Although, as I always say on the show, context matters. And as you just heard, the gents sort of classifying this as a more speculative buy. So it's not necessarily a core portfolio holding that you'd back the track up into, but definitely in terms of having some exposure, it was a yes from our two experts. What does that mean? It means that as of today, WhiteHawk is in the portfolio that we run here at The Call, and we've been running this portfolio since July 1. NabTrade are our partners and sponsor of that, and they've been keeping a track of it for us. So let's have a look. How's it gone? You'll see on your screen that, the last little while here, the weekly and monthly returns have been dipping into the red. But that has turned around recently. And as you can see, the 6 or near 7 month performance has been outstanding, creeping towards all-time highs there, which is really great to see. There's lots of chops and changes. The most recent ones, well, yesterday, if you were watching, you'd know that we had our ETF special, and that got the Beta Shares Global Banks ETF into the portfolio. Recently, we've also had Objective Corporation and Magellan Financial Group, Big Tin Can and Nick Scully added in as well. And if you want to find out all the other moves, just head to ausbiz.co/portfolio. All right, let's get into the back half of the show. Jason, here's a really interesting stock. This is one that does electronic parts catalogs, aftermarket components for automotive industry. Sounds a bit weird, but it's a business that's been around forever and a day. They've had a pretty good history over the last 10 years or so. Shares up about 5-fold in that period. Pretty profitable business. Do you like it? Jamila wants to know.
Yeah, big solid business. $700 million market cap. Not in the ASX 200 though. It's ASX 300 stock.
Yep.
So it's very much it's been it's past being an emerging company now, but it's still growing. And management are forecasting to grow revenue, like double it over the next 5 years. So they've got some pretty solid growth plans. They've recently did a capital raising. I think they raised about $84 million, and it was interesting listening to what they had to say about that. They said that they're preparing the business not just for defence but for attack. So it's very much like growth is on their mind. And look, it's got a high PE. It's PE of 30ish, so it does need to have growth happening. And but look, they're doing it. They're getting the runs. Earnings per share was up 10%, revenue 12%, net profits after tax up 15%. And they're doing this. They're seeing growth in consecutive years. It's not just like they've had a good year. It's been an ongoing thing, and that's why we've seen such good share price performance over time. Overall, look, I like the stock, but look, it's just looking at the share price over the last 9 months. It's been relatively slow to recover following COVID. Like you look at some stocks and they've recovered a lot stronger than this one. This one, I don't know why, but it has been lagging a bit. It's recently been pulling back as well, so that's another caution for me. So it looks like it's trying to regain some momentum. But look, it did have a really big run up during 2019. Mm-hmm. So perhaps that's part of the reason why it is still lagging a bit. Because often when we get these big moves, it can take time for that to just work through and for the shares to consolidate. Yep. I'd rather buy it into a bit of strength. I'd say that I'd wait for the current pullback to stabilise, and I'd look to buy in a break above December's high.
Mm-hmm. Okay. Hey, Carl, what do you think? Some really impressive growth there, as Jason was pointing out, though you are paying up a bit for it. Can we get it over the line?
No, not from me. Not that it's a bad company. It's a great company. There's great product, great usage and adoption within the market, and great scope for further adoption because it is such a good product compared to its peers. So, look, it's a very good company, and the sticking point for me is just the price. You keep mentioning, look, it's in high 30s. It is growing, but it's more sort of a low double-digit growth, which, don't get me wrong, it's still great growth, but it's harder for me to justify the valuation where it is right now. And I think that's why it's struggling. It's not that screaming buy where you go, this is a no-brainer, I have to get in. I think, the people that run the ruler over it do the DCF valuations and then plug the numbers in and look at the price now and go, you know what, there's just not enough in it for me to really back this one. And I think that's why it's struggling. However, given the strength of the underlying fundamentals, you do have to pay attention to it. And if earnings increase and therefore appetite increases, I'd be happy to buy it. As Jason says, I'll give you the December high, which is 202. So if it's moving above that, then I'm starting to get more interested. But for the time being, right stock, wrong price, wrong time.
All right. Okay. That was some good insight there, Jamila. Hopefully it has helped you. One thing I like about the business is it's got some pretty potent network effects, network effects have to be the two most beautiful words in investing, doesn't it? Guys, we have to pick up the pace here a little bit. So, Carl, let's talk a bit about Moneyme, another stock that is a bit under the radar. MME, Costa wants to know, buy, sell or hold?
Yeah, very, very interesting one. Seems to be growing its business very well. Some of the projections for this and some of the consensus numbers I look at have growth off the charts for the next few years. And I can't kind of see where that's coming from, so my brain stumbles at that point. Also, given that we are looking again at high multiples that you're paying, and I guess justified if they can execute on that growth. I'm not sure if they can. We probably should discuss what they do. So they do personal loans between 2,100 up to 50,000. It's a purely online product. So you go on, put in your details, you get vetted, and then you get the loan. They also just starting to move into sort of a buy now, pay later product as well. They've got about 140 retailers, but that's very small when you consider the competitors.
Of course they are
there.
moving into that space.
Yeah, of course. So it's pretty much the personal loans. I'm going to cut a long story short here. If they meet all of these expectations, then it could be good. I can't see it happening, so I'm skeptical. I think the chart reflects that as well. It's very, very flat for the last 6 months when the market's done very well. So it's underperforming the market. There's probably a reason for that. I can't get excited about it right now.
Yeah, some interesting insight there from Carl, Jason. I guess the other thing you might have to watch here is too where we are in sort of the credit cycle and the rest of it. You know, things are going surprisingly well given what's happened in the world recently. But it is a business that I suppose when times get particularly tough, they could see increasing defaults. Is that a consideration?
It's interesting. Last year, last year was a good year for them. So the COVID year, or the COVID financial year was a good year. There was more demand for borrowing from them. So they say that when their prospectus came out before listing, that on most metrics they're running ahead of prospectus forecasts. So look, they're definitely moving in the right direction. There is a bit of a story there. Their loans are up from 76 million to 178 from 2017 through to now. Revenues up from 16 to 47 million. So look, all that's going in the right way. But I look at the chart and there's just nothing happening there for me. It's only been listed for a relatively short time. There's no trend there. Look, if it started breaking up above $1.60, well then maybe you could say there's the start of an emerging trend. But it's from my perspective, I prefer stocks with a little bit more price history than we have with this one.
Fair enough. Okay, so Costa, there's some added insight for you, but it also means that because we couldn't get a unanimous buy, that we're kicking it out of the portfolio. It was in the portfolio, but after today, it will not be. Let's talk Vita Group. James has sent this one in, Jason, and again, just a reminder on time, but they own Telstra stores. They also in the beauty area now with laser clinics, I believe, as well. Pretty decent history. One thing that stuck out, the PE's on 7.
Yeah, really interesting stock. It's been around for a while. Founded in 1995. Started out as Phone Zone.
That's right.
And then turned into the Vita Group and do stuff with Telstra. And they've got the skincare line they've brought on, I think, in 2017. Yeah. It's real boom bust story. This with the share price anyway. It's 2015, 2016. It was, from memory, it was the ASX 300's best performing stock. In the next financial year, it was the worst performing stock. Yeah. So that dubious honour of being best and worst. And booted out of the ASX 300 a few years ago. It's in the All Ordinary still. Market cap 178 million. Look, I think. Just looking at that weekly chart profile of the boom bust, it's got that classic look of, like you see it in NASDAQ and Bitcoin and Japanese equities. The uranium price in recent times, where it goes up a long way, comes all the way back down the bottom, and then for years it just plugs along the bottom. And people lose interest, they lose focus, they stop looking at it. I think that's where we are now, and I think it's getting interesting. It's on that low PE. They've got revenue growth. The business seems to be performing well. Got no debt, and I look at the daily chart, and it doesn't look like it's quite ready yet. It's but it looks like it could be about to break. I'd have this at a buy at a break of $1.15. Buy at
$1.15 break. I'll put it down a buy for the purposes of the show. Carl, what do you think, just quickly?
Yeah, look, it's totally confusing, this one for me. It's a hodgepodge of businesses. So we've got 100 Telstra retail stores that they manage. They've got some IT services that they provide to small to medium enterprises. They've got a technology accessories brand, so mobile phone accessories, speakers, things like that. And then they've got their cosmetics brand as well. So, I get the accessories and the Telstra stores, that makes sense, but the cosmetics and the rest of it. So how do you manage those? Do you have the right expertise within the business to do all of those things at once? I'm not so sure, but it looks very cheap. It's often you can get that PE trap where the E part of the equation is declining and expected to halve, and therefore the PE of 7 really should be 14 or a multiple of that, right? It's not the case. Revenues are quite steady. They're not shooting the lights out in terms of growth. It's sort of mid-single digit. But it's hard to go past it on the valuation perspective. So, look, if you had it, I would hold it. If you don't have it, there's better things out there for me. Like I think it's about finding the best plays in the positions. This position is really sort of a steady stock with limited downside and a good yield. That's the position you're trying to fill, and I think you can do that elsewhere in the market. So it's a no for me on that basis.
Okay, so
the chart's very flat. The chart's very flat.
Yeah, man,
those views.
That definitely came through when we had it up on screen before. It might be a bit of a scale issue too with that big spike we saw, but yeah, not a lot's happened for a while. But it was in the portfolio, so this one's on you, Carl. We're going to hold you responsible
Okay.
if it goes well from here. But look, so that is now kicked out. Let's talk bingo now, Carl. This is super interesting. This has come up on the show. I want to say a few weeks ago. There wasn't. I forget who was on at the time, but I remember the comments weren't too favourable. And then a takeover bid came out of nowhere and shares had this big jump, sort of making fools of us all here. So one of the things that's interesting about this bid, which is around about $3.50, I think is a couple of key words in here: unsolicited, highly conditional, non-binding and indicative. And it's interesting to note too that the current market price, a bit of a discount to that bid there. So there is perhaps a bit of skepticism from the market. What do you think? What do you do with a company that has got the potential of a takeover hanging over it?
Yeah, look, I don't know. I like this stock. I've liked it for a while. So, we've had it as a buy since September, around about 240. So it's obviously up from that. I think it's a really, really good business. It's had a little bit of a tough time over the last couple of FYs, but they're just sort of coming out of that now and had some really good growth come through earlier in the year in that first half, and a good update later in the year as well, saying that everything's really on track in a substantial way. So no, I like the stock. I think it's the right stock. I don't think it was particularly expensive when we bought it. It's now everything changes, right? Because it's significantly up from that because of this takeover bid. But it's kind of at where I thought it was going to go anyway. So how do you deal with that? It's kind of at the price where I thought it could get to. I think if you're in it, I think hang on to it because I think the bid undervalues the stock somewhat. If you're not in it, there's no point buying it here at this stage. If you lose that big jump.
Yeah, it's a really good point. I suppose that's the thing to be mindful of, Jason. If nothing eventuates here, the price will potentially, at least in the short term, go back down to where it was. Again, sorry to keep reminding you guys on time, but we are running up against it. So just quickly on bingo, what do you think?
Yeah, look, it's like I'd a buy in that this is the same time as Carl back in September. And but look, I think the takeover really muddies the waters with this one. Like, takeovers in the old days was you get the takeover and it was the first bid is never the last. Nowadays it's like, the first bid, will it even be there? You don't know. So like, what do you do? It's only 20 cents below the proposed takeover, so your upside's potentially capped. The takeover goes away, you've probably got more downside than you do upside. So from a risk reward perspective, I just couldn't buy it here. If you've got it, I'd definitely be holding it. You saw something similar with Village Roadshow last year. One of these takeovers with non-binding came out. And then the COVID started to happen, and the bid went away, and the share price collapsed. So yeah, buying for a small potential upside doesn't make sense. I'd leave it. Yeah,
it makes a lot of sense to me. I hope that has helped you, David. Okay, we're at lucky last stock of our list today. Samuel Jason has written in asking about Grange Resources. So an iron ore miner. They also produce pellets down in Tasmania for that. It's actually been around since the 90s. So a long history here, but a lumpy one. Is it something you'd buy?
Yeah, look, I really like resource stocks generally. I think the next few years could be really favourable for resources. And, it comes from two angles. There's the infrastructure. A lot of global infrastructure is likely to be built in the recovery from COVID. And also the other prong is the potential for central bank balance sheets to continue to blow out. And I think that's supportive of real assets like commodities. Iron ore, it's front and centre for infrastructure. So you look at the share price of Grange, it's not inflated. It had a rough period. When was it? During the 2013, 14, 15 thereabouts. But it's starting to emerge from that. It's starting to now see the early signs of a potential trend, and I think the risk reward is quite favourable. It's the sort of stock which could run a very long way. I think the downside is quite contained, and I'd be look, I'm a buyer.
We're a buy there. Hey Carl, what do you think here is? Jason said there's a couple of different considerations here. One of the commodity, one of the general economic landscape, one of the actual business itself. Is it something that piques your interest?
Look, it's an interesting one, Grange. It's been around forever. It's actually, I think, Australia's oldest iron ore miner. So it's been mining iron ore longer than anybody else out down in Tasmania. So it's not a Pilbara one. I looked at it. I tell you what, I look at this a lot. It is not a stock that is unfamiliar to me. I looked at it in June when I looked at Fortescue. We put a buyout on Fortescue. I didn't put a buyout on this one. I looked at it in August. I put a buyout on Mincor. We didn't put a buyout on this one. Subsequently, I think we put out buys on BHP and Rio, and then we didn't put it. It keeps getting overlooked by us over here because of its, I guess, inferiority to the other iron ore miners. So it doesn't make it a bad stock. It just doesn't make it the best stock, I think, for your portfolio in this space. And the problem with it is it's a bit of a one-trick pony. So whilst many of those other iron ore miners have more diversified operations from multiple mine sites that they're getting their ore from, these guys have a single mine down in Tasmania. There's a very, very greenfields project in southwestern WA that they're looking at, but that's environmental tick, but still pre-feasibility. So there are risks with having that single mine. If the weather goes through in the wrong way, that's a problem. Look, it's a decent mine life though. It's a decent asset, but they're producing pellets, not fines. There's a few things going on. They're a high cost producer, and that's kind of the problem. So when the iron ore prices, if the iron ore prices come back to 100, 120, they're just cash flow positive. They're making a little bit of money, not too bad. Up here, they're making money hand over fist. So it's kind of the right time for them, but you have to be of the opinion that iron ore prices are going to stay up. I think your downside's fairly limited because it's certainly not expensive. It's got a great dividend yield. So on that basis, this could be the final and last iron ore stock that we add to the portfolio. I'm doing it now. There's no research note on this at Think Markets. Go to the website for details, of course. I'm doing it on the show, and then I'll write one up later. We're going to add Grange. Now we've got the full house. We've got all the iron ore miners right now.
So we've got another double buy from our experts. Exciting stuff. Good way to end the show. Let's do a quick recap here. We started off with Infomedia, a business that got a lot to say about this business, but in terms of the trend, it just was not favourable according to the gents. So we couldn't get that one over the line. Same to be said for Moneyme. 2 thumbs down on this basis. Look, it's got to be said, the sales growth there is phenomenally high, but there are a lot of considerations with credit businesses, as the gents pointed out. So some food for thought there. We then talked about Vita Group, really interesting business. It's really come back a long way from its glory days. The comments being, though, it does ostensibly look extremely cheap at this point in time, and for that reason, Jason was a buy, I believe, Jason, wasn't it? But as long as it could get above $1.15.
Yeah, it was a buy into strength. It's too flat at the moment. We need to see that breakout of momentum.
So if it goes up a little bit there, James, that might be one to look for. But for Carl, it was just a hold at this stage. We then got to Bingo Industries, and both gents, credit where it's due, picked this one late last year. It's done very well for them, but at this point in time, it's not one that they would buy. As Jason rightly pointed out, you've got very little upside here if the takeover goes through, but potentially a bit more downside if it doesn't, and this is an unconditional bid, so that is certainly possible. But we did end on a bit more of a positive in terms of Grange Resources, a bit of a one-trick pony here, but a very, very long established business. If you've got the iron ore price moving in a favourable direction or just holding at a favourable level, these guys are going to make good money, and for that reason and for a few more, the gents were both happy to put their money into the ring there, and so that is a double buy, and that means it is added to the calls portfolio. Well, we made it to the end of the show, and bang on time too, so we've done very well.
How good's
on
that?
that front. How good is that indeed, Jason? It's really great to have you on the show, and we hope to see you again.
Been brilliant, thank you.
Always fun. And Carl, mate, good luck over there in Perth. Always appreciate your insights.
Yeah, cheers. So it turns out the guy from WA now officially has a buy on every iron ore stock on the Australian Stock Exchange. There you go.
Who'd thunk it? Well, that is it for us today. Like I said earlier, please go to our website to check out that portfolio that we are running. Lots of good ideas there. And thanks again to NabTrade for sponsoring that for us. And please send us your suggestions. We got a lot of new suggestions today, which is always nice. And if you want to do that, you can go to Twitter, Ausbiz TV. I saw one come through on Twitter earlier today, so thank you for that, viewer. And also email the call@ausbiz.com.au. Just a couple of words on that. We do tend to sort of operate that as democratically as we can. So the more popular the request, the more likely it is to get through. But if you've got a stock that you're desperate to hear us opine on, please be patient. We will do our best to get to it. That's it for today. We'll be back with the last show of the week tomorrow. Until then, thanks for your company.